Welcome to the chapter on financial markets. Understanding financial markets is crucial for making informed investment decisions and comprehending how capital flows within the economy. In this chapter, we will cover primary and secondary markets, stock markets, and bond markets. The primary market is where new securities are created and sold for the first time. This is the market for initial public offerings, or IPOs, where companies sell shares to the public to raise capital. The primary market is crucial for companies looking to expand and for governments seeking funds for projects. For example, when Facebook went public in 2012, it issued new shares in the primary market, allowing investors to buy them directly from the company. The secondary market is where previously issued securities are traded among investors. This market provides liquidity and the ability to buy and sell securities without affecting the issuing company. The most well-known secondary markets are stock exchanges like the New York Stock Exchange and NASDAQ. For example, if you buy shares of Apple Inc. on the New York Stock Exchange, you are participating in the secondary market. The transaction is between you and another investor, not the company. Stock markets are venues where stocks or equities of publicly held companies are issued and traded. They are a key component of the financial market, providing companies with access to capital and investors with a slice of ownership in a company and potential gains based on the company's future performance. Stock prices in the market are determined by supply and demand. Factors influencing stock prices include company performance, investor sentiment, economic indicators, and global events. For example, if a company reports higher than expected earnings, the demand for its stock may increase, pushing the price up. Conversely, if the company faces a scandal, the demand may decrease, leading to a drop in the stock price. Stock market indices measure the performance of a group of stocks, providing a snapshot of market trends. Common indices include the S&P 500, Dow Jones Industrial Average, and NASDAQ Composite. For example, the S&P 500 index includes 500 of the largest companies listed on stock exchanges in the United States and is often used as a benchmark for the overall market performance. Bond markets, also known as debt markets, are where participants can issue new debt or buy and sell debt securities, primarily in the form of bonds. Bonds are fixed income instruments that represent a loan made by an investor to a borrower, typically corporate or governmental. There are several types of bonds. Government bonds are issued by national governments and are considered low risk. Municipal bonds are issued by states, cities, or other local government entities. Corporate bonds are issued by companies to raise capital for expansion or operations. The price of a bond is determined by the present value of its future cash flows, which include periodic interest payments known as coupons, and the repayment of the principal at maturity. The formula for the price of a bond is P equals the sum from T equals 1 to T of C, divided by 1 plus R to the power of T, plus F divided by 1 plus R to the power of T. Here, P is the price of the bond, C is the coupon payment, R is the discount rate or yield, F is the face value of the bond, and T is the number of periods until maturity. For example, suppose a bond has a face value of $1,000, a coupon rate of 5%, and matures in 10 years. If the current market yield is 4%, the price of the bond can be calculated using the formula mentioned earlier. Yield to maturity, or YTM, is the total return anticipated on a bond if it is held until it matures. It is expressed as an annual rate and considers all coupon payments and the difference between the bond's current price and its face value. For example, if you purchase a bond for $950 with a face value of $1,000, a coupon rate of 6%, and 5 years to maturity, you can calculate the yield to maturity by solving the bond pricing formula for R. Understanding financial markets is essential for making informed investment decisions and comprehending how capital flows within the economy. By grasping the concepts of primary and secondary markets, stock markets, and bond markets, students can better appreciate the complexities and opportunities within the financial landscape.